Good afternoon, and welcome to the Time to Take a Closer Look at Branch Efficiency webinar brought to you by Kronos. My name is Chad Davis, Senior Industry Marketing Manager at Kronos, and I'll be presenting along with Dale Westwood, the EVP Chief Retail Officer at QNB Bank for today's presentation. So we're first going to kick things off by talking about current banking trends in the branch. We're then going to take a closer look at teller line study findings from the recently published Kronos FMSI teller line study. We're then going to hear from Dale from QNB Bank, who's going to share her experiences around branch efficiency and using the Kronos FMSI scheduling and performance analytics software. At the very end, we're going to look at best practices and management tips to close out the presentation. Over the past 25 years, the banking industry has witnessed a costly combination of steady labor cost increases and continued branch traffic declines. Average monthly volume for teller transactions is down 34% since 1992, while teller labor costs for the same period have risen a staggering 147%, forcing financial institutions to respond. According to the FDIC, insured financial institutions operated 91,851 branches in 2016. This is down 8% from an all-time high of 99,550 locations in 2009. The decline marks the 7th consecutive year that the number of offices has declined. As you can see on this slide, the ratio of population to branches fell from 9,340 in 1970 to 3,518 in 2016, a stunning 62% decrease. During this period, the U.S. population grew by over 50%, while the number of offices more than doubled. Coupling the decline in the ratio of population to branches and the recent decline in bank branches suggest that the market is starting to correct itself from being over-branched. Following the rapid increase in the number of bank branches throughout the 1990s and during the 2000s, subsequent branch closings and consolidations, coupled with slowing brick-and-mortar development, illustrate that the financial industry recognizes a correction is needed. As more customers migrate to online and mobile banking, they are visiting branch locations less frequently, forcing a change in the traditional branch staffing model. Despite declining branch numbers and the increased adoption of mobile banking, it's unlikely that the branch office will go away altogether. A more likely scenario includes a banking landscape that combines the ease of mobile and online banking for simple transactions with physical branch locations where account holders can receive service and support for more complex transactions. When it comes to sophisticated transactions, most account holders still prefer to meet in person with a knowledgeable staff member at a branch location. According to the 2016 J.D. Power Retail Branch Banking Satisfaction Study, brick-and-mortar branches are still a key channel for servicing consumers in those moments of truth, such as resolving problems and dealing with complex transactions. This is evident in the user preference patterns, with the branch continually performing higher than online channels in terms of enhancing product understanding and reducing future problems. In fact, traditional brick-and-mortar branches offering transactions, account openings, and a loan officer on site accounted for 90% of all offices and declined in numbers just 1.2% in 2016. These findings suggest that financial institutions would be well advised to invest in technology that makes each branch experience as satisfying as possible for the next account holder. Unlike other vanishing retail specialty stores like book and music locations, most consumers at some point depend on the face-to-face expertise of financial service professionals. Naturally, with the significant impact banking products can have on individual finances, they often desire the extra attention to help establish trust and make sure they are getting the most out of each interaction. Ultimately, the trust and relationships developed in person have been and always will be paramount in the financial services industry. Even as automation is changing the way people bank, there will still be a need for brick-and-mortar branch locations staffed with employees who can help consumers with complex transactions such as opening accounts and applying for loans and mortgages. The challenges for bank is evolving to meet these changing customer expectations. Higher quality interactions can lead to additional product sales and cross-selling, which is exactly the type of exchange financial institutions are seeking between account holders and branch employees. Higher value interactions deliver a better return, especially when compared with the interactions that typically occur at traditional branches, where thousands of simple deposits and withdrawals are processed per day, costing over $1 per transaction in labor cost alone. Taking a systematic approach that leverages the right blend of technologies, training, and architectural designs, banks and credit unions can make significant strides toward creating profitable, sales-centric branches that succeed today and remain viable in the future. All right, at this point we're going to review the FMSI 2017 teller line study metrics. The FMSI teller line study is based on more than 16 million teller transactions from banks and credit unions across North America taking place during March 2017. The study shows a 26-year trend in increasing labor costs and declining transaction volumes. The 2017 average branch teller volumes for both banks and credit unions show a slight increase in the 5-year trends on the teller line study, even as the cost of labor continues to rise. There are a number of factors that can account for the 2017 figures, including branch consolidation and a leveling off of the influence of technology such as mobile and online banking. Specifically, a significant percentage of older consumers are not adopting mobile, with Deloitte reporting that only 18% of adults aged 60 and over taking advantage of online banking services. Serving these consumers will continue to require in-person interactions at branch locations. Regardless of the last 5 years, as you can see, a 34% decline in volume since 1992. It's still a significant drop in transactions over time. This next slide highlights salary and benefit hourly pay rates. As you can see, a 100% increase since 1992, with a $17.73 average salary and benefit rate for current frontline staff. This, combined with a drop in transactions, has led to a 147% increase in labor costs per transaction since 1992, with the last number being $1.19 per transaction on average. Then naturally, with the drop in teller transactions, there is a drop in productivity as well. Since 1992, where it was as high as 18.4 transactions per hour, the current number in 2017 is 14.9, which equals a 19% decline in productivity since 1992. Here are the 5-year trend charts for banks and credit unions. As you can see, as we kind of talked about a little earlier, there is actually a slight increase in volume. Some of the reasons for that we mentioned were consolidation of branches, along with a leveling off of the the adoption of technology. But banks have seen an 18% increase in volume since 2013, while credit unions have seen a 10% increase in volume on average per branch. Here we have the 5-year trend chart for teller processing labor cost per transaction. As you can see, the banks had a 6.6% 5-year labor cost per teller transaction increase, while credit unions saw a higher increase in labor cost at 17.2% increase since 2013. And then we broke out actually the FMSI top performing clients in this trend chart here, and you'll see them in the next one too. And for those Kronos FMSI clients, you're looking at 32% increase in teller transaction costs. And here we have the average transactions processed for teller hour worked, also known as teller productivity. And banks experience a 1.6% increase on average, while credit unions saw an 8.7% decrease. And the top performing FMSI clients, top 10, are at a 13.3% decrease. But as you can see, the numbers for the FMSI top 10 clients are still significantly higher than the banks and credit unions broken out on average. The data in the teller line study comes from financial institutions across North America and shows the 5 most common transactions, categorized by when they occurred during the workday. We have depositing checks, which made up 26% of the total, withdrawing cash at 22%, depositing cash at 11%, and then loan payment checks at 5%, and then depositing in bulk at 4%. In general, the data tells us that regardless of type, transactions are spread proportionally throughout the morning, lunch, and afternoon periods. The lion's shares of transaction types fall in the deposit and withdrawal categories. We also note that outside of the top 10 transaction types, all other categories did not even register a full percentage point in relation to the total transactions. We expected to see a disproportionate number of transactions during lunch period. Perhaps as other channels have absorbed transactions from the branch, the period most impacted has been lunch. We suspect busy professionals who formerly used their lunch breaks to visit the branch were strongly incentivized to adopt more efficient technologies, such as mobile deposit, so they could focus on other tasks during the workday lunch period. All right, at this point, I'm going to pass it over to Dale at QNB Bank, and she will be talking to you today about her branch operations. All right, Dale.
Thank you, Chad. My name is Dale Westwood, and I am the Executive Vice President, Chief Retail Officer for QNB Bank, located in Quakertown, Pennsylvania. We're just a little over $1 billion in assets. I'm responsible for 11 branches, a call center, and an investment center. And back in early 2011, we really began to notice our transaction counts declining. And we found that we were really struggling being able to generate the reports necessary to assist us in staffing the branch appropriately. When positions became available, we took a hard look at if we really needed to replace those individuals. But we were making these decisions without the necessary data to be able to make a educated decision. We decided on FMSI, I think it was early 2016, but we actually started our relationship with them in July of 2016. And it has been a very successful partnership to this point. To give you an idea, an example of our declining transactions and what we've been able to do as far as FTEs, in July of 2012, in my branch network, I had 69.5 FTEs. And in July of 2017, I'm down to 65.3. So we're down about 4. Then when I first looked at this, I thought, well, you know, 4, that's not too bad. But we added a branch between that time and we actually added 5 FTEs. So really we're down about 9 FTEs, which has changed a lot of how we do things. But with the having better data to staff our branches, it seems to be working rather well. In August of 2016, where we started with FMSI and we started gathering data, our cost per transaction was about $1.20. And you can see, as you know, it fluctuated up and down throughout the last year. And May, we're down to about $1.04. And we continue to see that improve, not just with how we are staffing our branches to meet our customers' needs, but also all those other jobs and activities that our employees need to participate in. For example, a compliance training that we're required to complete every year. We actually schedule that into the scheduler so that someone knows on a Tuesday afternoon they're not on the teller line, they're in the training area getting their classes done. QNB Bank is a very big believer in education, also in practicing. We give our employees tools to be able to do their jobs better, but we also practice. We do role plays and we do drills. We actually schedule all those activities into the scheduler. So there's no excuse anymore for people to say, I didn't have time to get my compliance classes done. Over the last few years, we've spent a lot of time discussing what our branch of the future might look like. And our focus really has been on our existing branches. Okay, how can we take all these branches that are pretty traditional looking into how we would look in the future? There's a fine line between the branch of the future and looking like what we like to call it the Jetsons, because some of the branches that we've toured and we've seen are very, very modern. We've actually partnered with a company now that's what they do. They help you design your branch and existing branches and new branches, and it's been very interesting because they have been able to ask us a lot of questions that we never would have thought of, to think about what is it that we want our branches to look like. Our focus was a lot on technology end of it, and while that is something that we still are very conscious of, also the market that you're in. We have some very traditional markets where if we would come out with a look that was totally, I don't know, ultra modern, it may not go over. So they're giving us some good ideas on how you can like wean your customers into the new branch of the future. We recently, in 2 of our branches, just installed cash recyclers. And it's interesting with the scheduler, we have a goal of how many transactions. I don't like the word goal, but a number of transactions per hour that we feel is good, it's comfortable, we're still maintaining that level of high customer service. And we have found that with cash recyclers, it's much easier for us to reach those numbers that we're striving for. And it's wonderful because instead of counting all this cash, our employees are having really good conversations with our customers. So the cash recyclers will definitely be part of our branch of the future. We also considered interactive ATMs, and we've actually really decided against them for now inside a branch. We're talking to people, and that it's not to say in the future we may not, but right now we've decided not to go that route. So our branch of the future will definitely be a mix of tradition and modern. Our goal is to have it open and clean looking, very warm and welcoming, focusing on the technology, customer friendly. we have determined that this is really a process, and will take a lot of work over time to make sure that we have the branch that we feel is at least QMB's branch of the future. Thank you, and I'll hand it back over to Chad.
All right, thanks a lot, Dale. All right, at this point, we're going to talk about management tips that we have to offer today. And they include scheduling staff to demand, analyzing core system transactions, better measuring service, leveraging smartphones in the branch, and improving employee engagement. All right, management tip number 1, scheduling staff to demand. With Kronos FMSI Scheduler, you can prepare schedules that optimally align staff, including universal staff, to actual account holder traffic and activity patterns based on your institution's core transaction and platform system data, such as that collected by the Kronos FMSI Lobby Tracker. This staffing approach ensures the ideal number of staff for both peak and idle periods. The ability to specifically identify and quantify idle time is the first step towards scheduling additional sales-related activities, such as training and supervisor coaching sessions or outbound sales relationship calls to account holders, which can be led to improve branch service. As you can see here, Ruth Hopper had an idle period between 8 and 10 a.m. So the scheduler was able to assign outbound calling for this time period, where Ruth is able to make outbound calls to previous visitors to the branch to follow up on loan activities or any other reasons for them to have visited to follow up on. All right, management tip number 2, analyzing core system transaction volume. Teller performance data is stored by a financial institution's core processor, and the HR department, especially transaction time, transaction type, and associate employee, can be used to collect and prepare frontline staff performance analytical reports. As you can see on this slide, we have a representation of a branch's FTE, or full-time employee forecast, based on volume per hour and day of week. Many institutions use charts like this one to help determine how many FTEs they need at their branch per hour. The number on this slide are derived from forecasted transaction volumes from an institution's core system. For example, if a schedule has 4 tellers scheduled to work at 8 a.m. on Monday, July 2nd, the time when staff needs is forecasted to be 2.6 FTEs. They should instead consider having one of these tellers come in at 9 a.m. This type of information can be extremely beneficial when forecasting training and measuring universal associates. Detailed universal associate staffing reports are available in the Kronos FMSI Performance Analytics solution. All right, management tip number 3. Track branch employee sales and service. Financial institutions can track, measure, and manage a cross-sell ratio in the branch platform environment with an on-demand sales reporting solution such as Kronos FMSI's Lobby Tracker. When an account holder arrives in the lobby, the product and service they intend to transact are recorded in the reporting tool, like with Sue here, or Nate. As you can see, they're here to close account and ask about an auto loan respectively. And it has how long they've been waiting for and what time they've arrived. And as additional products are sold, this information is also captured once they're brought into an assist mode and whether or not they cross-sell. Speaking of these cross-sell numbers, we actually collect that for a report that we call our cross-sell ratio average for a month report. It includes each employee. For example, One universal associate, on average, could sell approximately 3 times as many products as the account holder originally intended to purchase when they arrived at the branch, while an other non-universal associate could only sell 1.5 times the product on average during the month. While management can use this valuable information to determine the effectiveness of its universal associate program and to help increase wallet share. All right, on to management tip number 4. Leverage smartphones to enhance the branch experience. From reserving movie theater seats to ordering pizza, consumers are accustomed to getting what they want on their smartphones, and fulfilling their banking needs should be no different. Financial institutions have made considerable progress in accommodating what account holders are asking for, but other industries are setting the bar higher, seemingly every day. For example, many businesses such as salons and service-oriented retail stores now offer consumers the ability to set appointments through smartphone applications. If your account holder are not asking for this time-saving and convenient capability now, they certainly will be soon. Sophisticated appointment applications, like the Kronos FMSI Appointment Concierge, should take into account each employee's availability and skill set, making sure to schedule each consumer's appointment with the right person at the right time. Learn more about scheduling appointments in the branch by downloading the Kronos FMSI 2017 Appointment Study, which can be found in the Resource and Insight page on the Kronos website. All right, the last management tip of the presentation, management tip number 5, engage employees and increase customer satisfaction. 5 of the top 7 attributes consumers consider when selecting a primary bank relate to bank branch personnel, while only about 1/3 of consumers consider technological improvements such as mobile banking or video access to a banker as top reasons to select a financial institution. Amid increasing competition within the industry, it is important to deliver the best possible customer service to attract and keep customers, and that starts with a satisfied and engaged workforce. A solution designed specifically for the banking industry, like the Kronos Workforce Ready solution, can help inspire employees to meet and exceed the expectations of today's account holders. By leveraging a human capital management solution that embraces the entire workforce with end-to-end employee lifecycle management, financial institutions can more effectively respond to the changing role of the branch and its employees. Historically, financial institutions have not had to worry about staffing their branches in response to a declining volume of transactions, because branch activities were always growing, in part due to a growing population and a rising economy. Instead, they were looking for where to add branches as new housing developments popped up on every corner. Management was convinced there wasn't a lot of money to be saved in closely managing teller staffing. Today's environment has changed significantly from those boom days, and the trends in this study suggest the market is now overbranched, a situation that too many institutions have largely ignored. Savvy institutions need to look inward and ask, could it be time to close some of our low-volume branches and/or adopt branch efficiency technologies? It's more important than ever for bank and credit union management to pay closer attention to operating expenses. The labor cost savings associated with deploying a focused, dedicated branch workforce optimization program have become too great to ignore. Using a human capital management solution to maximize staffing investments leads to improving sales and service levels. A more sophisticated scheduling approach makes it easier to identify frontline staff idle time as well as time employees spend waiting for consumers and transactions. In this way, branches can get more accomplished during these systematically identified lull periods by proactively scheduling outbound selling campaigns, as an example. A reduction in operating expenses by consolidating low-volume branches, coupled with a comprehensive human capital management strategy, can better position your institution to face the increasing challenges of the 21st century. Well, thank you for joining us today. And a special thanks to Dale for presenting. I wanted to remind everybody that additional white papers and studies, along with articles that we've written around branch banking and human capital management, can all be found on the Kronos webpage, Resource and Insight, which can be clicked on at the top of the Kronos.com homepage. Thanks again to everybody for joining us, and have a great day. All right, bye-bye.